I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our latest Following the Money podcast. Today, I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. In our previous Following the Money with Asbury Research podcast on June the 19th, we said that investors are becoming too bullish, which warned of the U.S. stock market's vulnerability to a corrective decline. 2 weeks later, the S&P 500 is exactly where it was on June 19th, while there is even more evidence of an overextended market that has emerged according to investor sentiment, options data, and standard deviation. Today is Sunday, July 2nd, 2023. Happy Independence Day to everyone. Now let's follow the money. First, let's look at the U.S. broad market. The S&P 500 finished last week at 4450, up 102 points or 2.4% for the week. The U.S. broad market index is now 611 points or 15.9% higher for the year and has risen by 6% since breaking out of its December to May sideways investor indecision pattern on June the 1st. Below the market, primary tactical support is at SPX 4325. The next formidable overhead resistance level is at S&P 4637. Now let's look at market internals. Market internals indicate the under-the-hood health of the stock market. I always compare it to when you go in for your annual doctor's visit. The doctor sees you coming in the office, your hair is combed, you have nice clothes on. He may make a mental note of what he thinks your health is. Then he sits you on the bench and he starts to measure your blood pressure and your pulse and your reflexes, and he may get a different indication of what's going on inside. Our Asbury 6 risk management model, which measures that internal strength, shifted to a positive status on May 18th, and the S&P 500 has since risen by 6.2%. The Asbury 6 remains positive heading into next week, with 5 of its 6 constituent metrics currently bullish or green. A shift to a negative status by the Asbury 6 would be necessary to indicate that a tactical top is in place in the U.S. stock market. Now let's shift over to sector rotation via our SEAF model, which tracks the investor asset flows as they move around the 11 sector SPDR ETFs. SEAF is an acronym, S-E-A-F, and it stands for Sector ETF Asset Flows. I built this model well over 5 years ago as it became apparent to me that the sector rotation was really speeding up and I need to have a better tool. This week's top-ranked sectors, according to the SEAF model, in order, are financials, communication services, and technology. This is where the money is currently going in the sector space. Financials is a new sector with favored status according to our model. It's new this week. Technology has been ranked among the top 3 sectors according to SEAF for 15 of the past 17 weeks beginning on March the 13th and has outperformed the S&P 500 by 11% since then. Communication services has been ranked as favored by SEAF since May the 15th and has outperformed the S&P 500 by 1% since then. You can read more about the SEAF model and see some graphics that go along with SEAF in my June 30th article for Forbes.com. Now let's look at domestic asset allocation. Thus far this year, our CARP model has favored growth, technology, and high beta stocks as overweights. CARP stands for Cross-Asset Relative Performance, and this model has been in the Asbury Research suite of models for about 5 years. Growth has outperformed value by 20% since first appearing in our model on January the 26th, while simultaneously outperforming the S&P 500 by 9%. Technology has outperformed SPY by 17% since first appearing as a buy overweight signal in the CARP model on January the 20th. High beta stocks have outperformed the S&P 500 by 5% since first appearing in our model on May the 18th. Now let's move to global asset allocation. Through the end of last week, only Brazil is outperforming the S&P 500 on a tactical and strategic basis, which for us is monthly and quarterly. And this is according to our U.S. versus the world model. Brazil has outperformed the S&P 500 by 5% since first appearing as an overweight in our model on May the 12th. So there it is. Our latest bi-weekly Following the Money podcast for today, and a short synopsis of what we think is particularly important to pay attention to as we begin the third quarter. More information about Asbury Research, including our data-driven models like the Correction Protection Model and Asbury 6 for wealth preservation, our CEF model for sector rotation, and our CART model for domestic asset allocation are all available at asburyresearch.com. You can use the Contact tab there on the website to request pricing for our premium services. If you'd rather just take advantage of the free stuff for now, you can go to the Asbury Research YouTube channel and subscribe for more access to additional audio and video presentations like this one. Finally, the legal stuff. This podcast is provided for information purposes only. It is not intended to be a solicitation to buy or sell securities. The performance indicated from backtesting or historical track record may not be typical of future performance. No inferences may be made and no guarantees of profitability are being stated by Asbury Research LLC. The risk of loss of trading and financial assets can be substantial. Therefore, you should carefully consider whether such trading is suitable for you in light of your financial condition. We'll see you at the next podcast in about 2 weeks.